Welcome to the Valuetown Fund show number 2. In today's episode, we evaluate Intel stock as voted on by Patreon. Thank you to the Patreon supporters. You guys make this show happen because I use every week the funds that are put into Patreon onto the actual investments done on the Valuetown Fund show. So Intel is definitely outside of my circle of competence. Which means, semiconductor company. I have no idea about this hardware stuff generally. I'm actually not even very strong at computers. But before we go into Intel, let's take a look at our current positions. Valuetown Fund has been in operation for 1 week as of this video. 50% having been invested in low-cost index funds, VTI, VXUS, and 50% invested in Activision Blizzard. So this is Webull, by the way. Link below if you'd like to sign up for a Webull account. You sign up and deposit money and you get free stocks. I get free stocks thanks to my affiliate link with them. A lot of value for both of us. Helps the show out a lot if you do that as well. The stocks that I'm going to get from you guys signing up will start hitting the account probably starting next show. First of all, Valuetown Fund up 4.72. $4.74 since it started, plus 1% in a week. That's really good. Now, I'm a long-term investor, but that doesn't mean that when news occurs about one of the companies I hold, Activision Blizzard in this case, and boy did I not expect this, information about companies does change their valuation. That's usually done through earnings reports, but sometimes news breaks. In the case of Activision Blizzard, they have been sued by state of California about their sexual harassment and sexual discrimination practices. This has not had that big an effect on the stock price. In fact, it happens to have gone up today. Ultimately, I do still believe that the fundamentals of Activision Blizzard are good. However, it is possible that other investors have not quite realized the severity of the allegations against Activision Blizzard yet. It is also possible that this is an overreaction on my side and that it will not ultimately affect the price much. However, the way I see it, and I am not really an ESG investor, which is investing based on a company's environmental, social, and governance factors. However, what I do believe is that ESG tends to affect companies in terms that companies should practice good ESG because companies with good ESG tend to have better stock prices and results. It is possible that this will create the necessity to move some employees around, that is bound to cause some delays in games or at least some amount of trouble, which I believe hasn't been priced in yet. I do believe that long-term the fundamentals of the company are still good, and it's quite likely that I'll come back and buy Activision Blizzard in a bit, but with their earnings report coming up soon. And I do believe it will be a good earnings report, by the way. I still think that. It's just there were additional risk factors that I didn't want to deal with. So let's sell it all today. Now, as always, at the beginning, not only do I recap what's happened to the portfolio, but at the very beginning, based on how much money has been contributed on Patreon, in this case it was $253.70. Plus, I happened to carry over $7 spare from the first week. Therefore, that gives me enough money to purchase 0.55 shares of VTI and 0.55 shares of VXUS. That is 50% of all the incoming money being put into low-cost index funds, Vanguard Total Stock Index, and Vanguard Total International Index. So on to Intel Corporation. My first stop is Finbox, where I get to learn the basics about the company. Intel Corporation, ticker symbol INTC, is based in the United States in the information technology sector, and that is in the industry of semiconductors and semiconductor equipment. As a note, I'm reviewing this on July 23rd. This is the day after the earnings reports, and I have purposely done so today because I looked up all the previous earnings reports, and that's where the stock has major movements, usually on the downside. And you can actually see that on this day, Intel is down 6.24%. Incredible. Intel Corporation designs, manufactures, and sells essential technologies for the cloud, smart, and connected devices for retail, industrial, and consumer users worldwide. This will make people's head spin. It made my head spin, and I actually still don't know these abbreviations. This, again, is outside of my circle of competence. The company operates through DCG, IOTG, Mobileye, NSG, PSG, CCG, and all their segments. It offers platform products such as central processing units and chipsets, and system-on-chip, multi-chip packages, and non-platform or adjacent products, comprising accelerators, boards and systems, connectivity products, and memory and storage products. By the way, it's in general, I do recommend that if you were to be investing into companies, you really should understand what they do. Because this is an informational and educational show, I break these rules because I review the stocks that you guys want me to review. And there's not that many things in my circle of competence, but it's fun to expand my circle of competence and learn about this stuff. It took a lot of studying to even understand what Intel did, by the way. The company also provides Internet of Things products, including high-performance compute solutions for targeted verticals and embedded applications, and computer vision and machine learning-based sensing, data analysis, localization, mapping, and driving policy technology. It serves original equipment manufacturers, original design manufacturers, and cloud service providers. Intel Corporation has a strategic partnership with MILA to develop and apply advances in artificial intelligence methods for enhancing the search in the space of drugs. The company was founded in 1968 and is headquartered in Santa Clara, California. Okay, so head exploded. So here's my understanding of what Intel does. Intel's in the semiconductor industry, and it is one of the very few, and certainly the only major United States-based company which actually still has factories which build semiconductor units. Actually a manufacturer of chips, basically. This has been found to be very important, at least in the US government's eyes. Semiconductors are really important, potentially a matter of national security to have at least some semiconductor production in the United States. These semiconductor factories are called fabricators, and when I say it's the only one, I should say it's the major United States fabricator. Thus, Intel Corporation both designs and produces chips. However, as of late, the chips that Intel has made, they're falling a lot behind on this technology, having stalled on their ability to produce on 7 nanometer chips for years. This has been very detrimental to their leadership role in the semiconductor industry. Because their chips are falling behind, both in design as well as in production, AMD has come to take lots of market share from Intel Corporation. This has not been good for Intel. Thus, Intel faces two major sources of competition. One, Taiwan Semiconductor Company, TSMC, is another fabricator which produces higher quality chips than Intel. Two, AMD. AMD uniquely took a very different direction from Intel. AMD sold off its fabricators and decided to just completely use Taiwan Semiconductor to basically have their chips produced somewhere else and just be chip designers. This has caused them to be able to not have to worry about the heavy cost in operating these fabricators. And they've come upon a very good chip design, a chip design that is far outpacing Intel's right now, and their chip is better. And thus, they have taken a lot of market share from Intel. And that appears to be a trend that will continue. So that's the state of Intel. So it's a chip designer and a chip manufacturer, and it's very unique in that it does both. And it's extremely unique in that it is a major chip manufacturer in the United States. So when you take a look at the price history of Intel, it has been steadily going up over the last 10 years. And when I say steadily going up, I should say up until around 2017, 2018, when essentially most of the downturns can be explained, and I do think it's very important to look at all of the downturns. Most of the downturns can be explained through their lagging technology, through basically announcing that their next generation chip was going to be under production, but delays have occurred. Their most recent downturn has been due to AMD coming out with very successful chip technologies, which have outpaced Intel's. Now, Intel has had a pretty good run-up, late 2020 until early 2021. This might be attributable to the fact that semiconductors were becoming more rare, and Intel is a semiconductor company, manufacturing company. New CEO in Intel with visionary ideas involving opening more semiconductor manufacturing, more fabricators. But they have since lost quite a bit of those gains. That is attributable to AMD coming and eating their lunch, so to say. You can actually see AMD versus Intel market share across all CPUs. AMD rises, Intel falls. Desktop, AMD has only recently beaten out Intel. This has happened once before, but Intel took that back and has held it for a very long time, until now. You got the laptop market share, and this is actually really important, the server market share. This is where Intel makes its highest margins. AMD, it's coming in there. Watch out, Intel. Now, obviously, when analyzing Intel, it was impossible to figure out what Intel did without figuring out what AMD, its main competitor, is doing. I also considered taking a position in AMD. I've decided not to because investors are pricing it as if it's going to do extremely well. I found it difficult to, without focusing entirely on it, to know if it was overvalued, undervalued, or like about right, just because it's expected to do really well, and with earnings reports coming out very soon, it could do really well, or it could, go under expectations. AMD is definitely going to be very volatile, but I think it is fair to say that AMD is expected to do very well. And it's just a question of whether or not the price of the stock is too high right now. Looking at some basic data, Intel pays out a substantial dividend, 2.5%. Has a pretty low PE ratio, 11.5 times. That's the amount that you pay per dollar earnings. Massive revenue, $77.7 billion, big company, with net income of $18.6 billion. This is a really big company. You look at the revenues, you might expect Intel to be decreasing in revenues based off of that news, but actually, revenue has been growing, and operating income has been growing. Markets are forward-looking, though, and it's possible that they're projecting that revenues and operating income will decrease, or margins will decrease. Or it's also possible that people have overestimated Intel's downside. In terms of balance sheet, Intel is currently holding about $6 billion in cash, with total assets valued at $153 billion, with long-term debt, or rather with total debt being only about $72 billion. Of course, assets greatly outweigh debt, and long-term debt of $33 billion. That we'll want to look at the cash flow to see if that can be paid off. But given how much more assets they do than debt, the debt is not an issue. The cash flow shows how much Intel is making actual cash each year. $35 billion, you can see they can easily cover the debt. Of course, this is a big chip company, and not just a chip design company, chip manufacturing company. So this company has a lot of capital expenditures in setting up these fabricators, the chip factories, and maintaining them. Very big expense. So in actuality, the cash flow is a bit lower. Probably more accurate to call it around 20 billion. But hey, that's pretty good. $20 billion in cash flow each year. I do like looking at the valuation ratios of the enterprise value multiple. So this is enterprise value against earnings before income, tax, depreciation, and appreciation. You can see that this is actually being valued rather low right now, which indicates that investors do not have very much confidence in this company. There were some good years where they went up to 6, 7, or 8 times multiple. But now, even in our historically low interest rate, and that has to be considered, like this multiple is despite our interest rates being so low right now. Basically, investors don't have very much confidence in Intel. This is mirrored in the price earnings ratio as well. Current S&P 500 PE ratio is standing at 46.8. So you can see that 9.3 is extremely low. Now, caution, this is where obviously you don't buy the company just because it has a low PE ratio. It's low for a reason. People have very little confidence in this company. Furthermore, throughout time, the PE ratio isn't that high because the company has a lot of expenses that aren't necessarily covered in earnings. Big chip manufacturer has to spend a lot on capital expenses. As usual, my next step is to look at the annual report of the company. Now, because this is a company that I understand less, I of course was going to understand the annual report less. But still, it's important to read at least the overview. So Intel is an industry leader, which is true, though that is growing more and more under question. Importantly, Bob Swan is the quote on the annual report 2020, and Patrick Gelsinger has recently taken over the CEO position, February 15th, 2021. Gelsinger is a well-decorated Intel engineer. He's rising to the CEO position from someone who's actually designed chips for years. Looking at the year in review, Intel achieved record revenue, 49% from data-centric businesses. That's basically servers, so to say. The dynamic of work and learn from home resulted in strong demand for notebook, while demand for desktop PCs weakened. Demand in cloud service providers market segment grew. We shipped a higher volume of 10nm products. The increased mix of 10nm combined with a higher portion of revenue from lower margin adjacent businesses offset higher platform revenue and drove a decline in gross margin of 3 percentage points, which is to say that they make less money from building notebook PCs or providing the chips for notebook PCs than for their DCG segment. We invested a lot of money into R&D, did a lot of capital investments, and we did lots of buybacks. Now, I'll save you a lot of time of looking through the annual report. Essentially, it's a lot of happy sounding messaging, but it's covering up a grim detail. And I think this is rather simple. Intel needs to get their 7nm chip out. The delays are costing it an immense amount of money. Someday, they will get their 7nm chip out. That, in essence, is the main important thing about Intel right now. To some extent, I found this a lot like valuing a startup company. Now, Intel is not a startup company, obviously, but they're relying a lot on this new product. When this new product comes out, it's a lot of execution. First, when will this new product come out? And then, will they be able to implement it well? Their latest Q2 report came out just yesterday. Theoretically good news. Q2 revenue and earnings per share were above expectations, and because of that, Intel is raising the full year guidance. The future is bright for semiconductor demand, more momentum of demand, and hey, execution, innovation, and growth. Those all sound like good words. This looks like some very good data. Revenue, $18.5 billion, up 2% year over year. By the way, results and year over year comparisons exclude the NAND memory business. So this revenue amount is actually lower than last year. It is fine to put it this way though, because they are selling part of their business off. Gross margin, it's 59%, which is up 2.9% year over year. By the way, this margin is also a little bit potentially off because it does exclude the NAND memory business. Earnings per share up as well. This slide speaks about why Intel stock actually went down. So comparing the quarter 2 2021 revenue to the quarter 2 2020 revenue, their data center group, which has the highest operating margin, 44%, this has gone down. The revenue has gone down. That's because of increased competition. But also the operating margin has gone down. That's because of the semiconductor shortage. And you might say that doesn't make any sense. Well, because their fabricators are a little bit outdated, they actually have to buy quite a bunch of these chips from Taiwan Semiconductor Manufacturing. And due to the shortage, the margins have gone down. They have to pay even more for these. I'm not entirely certain about that, by the way. The slide does say the operating income is down on increased R&D and 10nm production ramp and 7nm startup, which is to say that, you know, more costs involved in producing more chips, as well as newer chips. What is really hurting Intel is the forecast, the guidance they're giving. So this is it for quarter 3. They're claiming that revenue will be up, gross margin will be down, earnings per share will be up. This is with their risen outlook, by the way. They bumped these numbers up. But what the investors hate seeing is that the gross margin is going down. In the 2021 outlook, they have risen the guidance on the revenue to be plus 1 billion, which is good because they already were only reporting a very small increase year over year. Now it's a tiny bit bigger. Wow, growth of 1%. Gross margin, though, is down, which is the big concerning part. This is implying that they're going to be making more of their revenue in less profitable fields, such as PC or notebook production of chips, instead of their data center. Due to not really understanding this industry much, I do rely on just reading good articles about why in the world did Intel stock go down 5.61% currently, despite their earnings beat. And I think this article is fairly good. Written by Ian King of Bloomberg. Investors focused on the 9% decline in the division sales of the lucrative server chips. This is because advanced micro devices is eating their lunch. But not only that, Amazon as well as Google are supplying their own components for their own data centers. That's really bad for Intel. This article speaks a little bit about Gelsinger, who started his career at Intel as a teenager and worked his way up through the engineering ranks. He said that Intel will fight hard for every order, and the earnings call actually have, in this quarter as well as the last quarter, emphasized we're really going to fight for every single sale. Now, knowing nothing about how semiconductor chips worked, I had to do a lot of background research to figure out how far behind is Intel versus Taiwan Semi Manufacturing Company in producing chips anyways. And the answer is yes, they're behind, but maybe they're not as behind as people think when they point towards the nanometer number. So TSMC is actually fully producing 5 nanometer chips and are like rolling out the 3 nanometer. And that sounds really good, especially compared to Intel, which is producing 10 nanometer chips and will be producing the 7 nanometer chip starting in 2022, hopefully. And it certainly looks like 3 is much smaller than 7, but due to density, Intel is better at using these. Yes, they're larger chips, but they're able to pack more in, and thus the capability is stronger, even though TSMC's chip size is smaller. That you really have to look at the equivalent. The 7 nanometer chip is the equivalent of like a 4 nanometer chip from TSMC. Now, that's not exactly great, which is to say that they're going to be producing stuff that's still theoretically worse than TSMC, but not by that much. They're not like 2 generations or even 3 generations behind. They're only, 1 generation behind. So this is the spreadsheet I have for calculating Intel's valuation. I grabbed the data from Finbox, exported their spreadsheet, and then plugged in my own numbers. I'm using a beta of 1 for Intel, which is a mix of the beta for semiconductor industries and taking into account what Intel's actual beta has been reported to be over 1 year, 2 year, and 5 year period of time, taking a little bit of each and setting it here. It's worth mentioning that AMD's beta is surprisingly high right now, possibly a value of 2, which I'm not entirely sure will hold for AMD, but it does show that AMD is a very volatile company. That is to say, ultimately, that I believe a vanilla semiconductor company is expected to produce 7.11% of return every year under our current environment of low interest rates, of interest rates expecting to go up, of a multinational company. It's very important to use your own numbers here. Right now I'm on the pessimistic assumption. This is not the worst case, by the way, for Intel. I had to do a bunch of research on what is the worst case scenario. And you might think this is very grim, and it is fairly grim, but I'm going to say this is not the worst case. This is assuming Intel doesn't get it together. Intel, this is its projection for this year. Revenue will decrease. This is mostly due to them selling a portion of their business. This is a one-off, which isn't expected to increase or decrease. So basically, revenue stays flat over the next years. That's despite inflation happening. So technically, they're selling less and less every single year for the next 4 years. Intel slowly starts becoming more and more irrelevant. They're still a huge company producing $73 billion in revenue. However, they stopped growing. They don't even keep pace with inflation. I've taken a earnings as percentage of revenue that they stopped growing despite continuing to pour money into R&D and, building more factories and whatnot. So keeping the amount that they spend the same-ish, holding across years. Very similar story for capital expenditures. They keep spending money. It is also worth mentioning that this isn't the worst case scenario. This profit margin could go down, especially since that appears to be a trend. I have selected a fairly low exit multiple for this scenario at 7 times EBITDA. When you compare this with similar companies like Qualcomm, NVIDIA, and AMD, you can see that their multiple currently is significantly higher than 7. 7, when you look across the history of Intel, that has ranged from 4 all the way up to 8. However, we are still at very, very low interest rates. So I do believe that low numbers are less likely. So I've taken a fairly pessimistic 7x multiple. The pessimistic outlook comes out with a fair value of $51.90. I will also say that since doing this basic research and spreadsheet, I have not actually changed the stock price. So let's set this to July 23rd and $53. So you can see that the market is pricing in closer and closer to this particular story. The analysts, the experts, they may not have updated it because this is fairly recent that the guidance has been improved. So using the guidance number of the company, 72.6 billion, the analysts are expecting a very small amount of growth in 2022. And then when Intel's chip production gets online, they join the 7 nanometer chip design, revenue starts growing 3% a year. Very humble. I think this is a reasonable story as well. It's a story where Intel turns it around a little bit. Not exciting growth, but they're not a dead company. That kind of story provides a fair value of $56.44. Now, I am going to say that I am not going to personally make an optimistic scenario for this because I actually do not know what is realistic in terms of a growth revenue for supposing that they come up with a breakthrough, or perhaps their semiconductor factories do really well, or perhaps because their new chip is actually pretty good and reviewed pretty well. All of those are possible, and growth rates could be substantially higher than this. But because I don't even know where to begin, I'm just going to weight the analyst prediction to be extremely high. I decided to look at the valuation from the analyst perspective if you did a 10-year growth rate as well exit, which is to say that my assumptions in this one are that you slowly decline from 3% revenue growth until 2% revenue growth forever. So assuming that Intel starts becoming just a very well-established, mature company, which it is, and starts just simply growing at 2% every year, this is the valuation you get when you plug in the general analyst numbers. Fair value $59.17. I think this is fairly reasonable. It's a story of how Intel continues to be relevant and grow at a humble rate. It's going to be part of the semiconductor industry. It'll produce its chips, it'll design its chips, people will use it, and it's relevant but not particularly exciting. Now, one of the very fascinating areas of Intel is what the analysts are actually forecasting Intel to be. And you can see it's a very split opinion, averaging out that Intel's price target from the analysts is $59.96, with very split opinions on whether you should buy, hold, or sell this stock. And you can actually see that today was a pretty good day to look at this because a bunch of analysts have come out and given their opinion on where Intel stock should be. That's because the earnings report just came out. And here's the final valuation probabilities that I've set. You'll note that because I consider my area of expertise rather weak on this, I've decided to say, okay, I think I can see where the worst case is, and not even the worst case. I can see a fairly bad case for Intel. And because it's not a worst case, I've actually put the probability of the pessimistic situation pretty high. And then I've weighted just the analysts, which are presumably the average. I haven't come up with my own optimistic estimate at all. Because analyst prediction targets are in a year, I discounted the $59.96 to today, which means they implied think that collectively they think Intel stock is worth $55.98 right now. However, it is worth mentioning that this is a very split opinion, which leads to a target price of $54.61 of what Intel theoretically should be worth right now. In fact, Intel plummeted past that price today. It was higher than the target price, but is now lower than the target price, $53 now. Which implies that there's a small upside to buying this stock. Now, with an up or downside with this in an industry that I am not very familiar with, despite spending a good amount of time to try to figure out the semiconductor industry, in an analysis where I mostly just trusted the analysts, I did still have a general idea that, yeah, Intel might actually just be a company that's kicked around and investors just don't like it right now. To the point that, even with fairly pessimistic numbers, and I think the analysts might be a bit pessimistic as well, and there is no optimistic situation in this analysis. Maybe some of the analysts are over optimistic, so that has been included. Intel's a risky buy, definitely not anywhere near a margin of safety. If you're making this purchase, you're making it under the slimmest of margins, where it's a really uninformed, maybe I'll buy it and maybe it'll go up. And only because this is an entertainment informational show where I've said, each time I'm going to value a stock and I'm going to take a position on it, I will take a position on it, but it's going to be a small one. And it's not what you think. Now, I'm not usually a technical analyst. I'm a long-term buy and hold person. However, this is going to be one of the very few times where I'm going to rely on technical analysis, the astrology of charts, a little bit more. As you can see from this 1-year chart, this is a flat line indicating the amount that is considered support. It's rare that Intel falls below this line. It's worth mentioning that, wait, refresh. Oh, there we go. Wait, where's the line? And you can see how technical analysis just changes, and you magically change your chart based on, if you refresh the chart. So there used to be this flat line here indicating that this was support, where, very rare that the stock price goes down below this point. However, due to the earnings report, that line has now changed to this diagonal line, where this is now apparently support. Honestly, it doesn't matter. So Intel has breached the support line of, it looked like it was 54 on the previous. One could say, oh man, it's in free fall. All things are open game now. But you know what? I kind of want there to still be a line here at 54. I think that it's reasonable. Also, fair value, if you are really pessimistic, 52. If you were reasonably pessimistic, 52. You could come up with a worst case scenario than this. I do believe in Intel, and all the research I did shows that Intel and AMD get into a competition. Sometimes AMD is winning, sometimes Intel is winning. In this case, AMD is winning. That's fine. So Intel's currently losing, but is Intel gonna lose forever? Is it gonna go down? I would argue no. So I'd like you to imagine that there is this line on the bottom where the pessimistic fair value is that line, $52. Intel is a very important part of the US economy and has been stated as such from the US government. In fact, the US government is coming up specifically with a bill just to be like, hey, Intel, we kind of like you, so we're going to give you some money. This, I'm not entirely sure, has been fully priced in, or perhaps it has been priced in and people are just even more pessimistic about Intel. There's incentives to open up semiconductor chip manufacturing in the United States so that we don't rely entirely on TSMC over in Taiwan, which I think is reasonable. Clearly, the US government is basically backing Intel because Intel is the largest chip manufacturer in the United States. This is basically a bill to give Intel free money. I'm not going to say too big to fail, but maybe? So essentially, there's almost like a floor. Intel has the blessing of the US government. Intel is a very long-standing company. It's got a new CEO. This new CEO does come from a chip manufacturing background and has apparently already cut down on some of the initiatives, which seem like they're moonshots. He's just going with a strategy, a practice strategy, and in fact has an ambition of building out more chip manufacturing. That's a bold step, and I'm not entirely sure about the chip manufacturing, but what I do believe is that someday Intel is going to get that new chip designed and start to be manufactured. And Intel's got like a pretty big brand to it. So I think we're near the bottom. Furthermore though, and this is probably really important, when you look at this graph, boy does this company not look exciting to own. It has been flat or has held for the last few months. In a booming economy, which we are in right now, I don't want to hold this stock. But what I'm going to say then is actually this. I want to make a bet that Intel will not fall by that much. And that's it. Can you do that? And I'm going to warn you right now, by the way, don't do this unless you know what you're doing. And this is literally fun money for me, so this is going to the entertainment part of the show, but it is both entertainment and informational. So it turns out there is a way that you can bet on a stock not going down. I want to place a bet that Intel is oversold and we're near the bottom and that it won't go down below a certain amount. And it is possible to do that and actually make money on it. This requires a little bit of education. There are two main types of options: call option, put option. Traditionally, if you buy a put option, that means that you expect that the stock will go down. So if you expect the stock to go down, then that means whatever strike price you bought it in, let's say, for example, you bought it at $53, which is the current price of Intel. If during the expiration date, the stock price drops below $53, then you make some money on it. However, it costs money to buy this option. The option represents that on a certain date, on a later date, you would like to sell your Intel stock at $53. So if the stock drops below $53, you're able to make a profit because you sell the stock at $53 to the sad person who sold you the option. The benefit to the seller is that this option costs money. And if the stock does not drop below the strike price, then, too bad. You bought some insurance and it didn't pay off. So my proposition is the following. I could sell a put. I could be the sell side at $50. And this shows I'll make some amount of money when I sell this option. The maximum profit I can make is the amount that I sell the option for. The maximum loss I can make is if Intel goes bankrupt, I lose $4,954 because whenever you sell an option, it represents 100 shares of the stock. 100 shares, I'd be forced to buy 100 shares at $50. That's $5,000. You subtract the credit of $46, you'll lose $4,954. Now, Intel is not going to go bankrupt next month, probably. Now, unfortunately, the Valuation Fund does not have the proper amount of funding to take on this risky of a position. We don't have $5,000, so this is about to get a little bit fancier. What you can do is also buy a put option at the same time that you sell a put option. In this example, suppose I were to sell the $50 put option, but buy the $49 put option. No matter how much it drops below $49, the maximum amount of money you can lose is $83, because that's the difference between $50 and $49 times 100. You can only lose $100 if you actually both own the put option and you have sold a put option. Now, this is a disproportional loss in profit. You lose $83 if you're wrong, but you make $17 if you're right. But because it is considered not so risky a bet, then, it's not worth that much. Now, the reason why I didn't take this position yet is take a look at the volatility of options. It turns out that there's something called options crush. Each time earnings comes out for a company, the implied volatility for an option decreases a lot. That's because before earnings comes out, nobody knows what's really going to happen. These timings matter a lot. As you can see, the volatility in one day dropped from 35.2 to 23.5. And due to this risk, I did not write an option at this date. And I'm going to explain one more thing. AMD's earning report comes out next week. And boy, do I not want to be holding this position when AMD's report comes out and possibly states that AMD has made a ludicrously large amount of money and we stole all of Intel's lunch and Intel plummets more. So what I'm saying is the following. I plan to take a bull put spread option, but not now. I'm going to wait until after AMD reports. And then next week, I will take this position. I actually feel comfortable enough rolling this bull put spread every month. That's going off of the general idea that I believe that Intel will be a fairly low volatility company, and the options may be mispriced in the sense that they expect higher volatility from Intel than actually exists. In this way, you're betting on the value of the expiration basically declining over time. This is considered to be a theta gang position as well. One thing I want to point out about options versus stocks are that when you buy a stock and you're a long-term investor, sometimes you get the price wrong. Sometimes you buy when it's actually, a little bit higher than what you should have bought for. But because stocks inherently go up, true, by the way, stocks go up. Why? Because stocks represent ownership in companies. Companies make money, and when companies make money, stock prices go up. Oversimplification, but options do not represent anything inherent. They're not owning a company. They represent like the ability to maybe own a company. And you don't have as long a time frame with options as you do with stocks, especially when you're doing this 1 month time frame thing. They are quite a bit more risky than stocks because options expire. There you have it. That is a theta gang strategy where you basically run out the clock. As long as the stock doesn't drop by a lot, which it could, by the way, it could, in which case you're losing a lot of your money. But you set a maximum loss because it's a spread. Downsides of this strategy are it does take a lot of capital to tie up. And if I had bought the stock instead, and one of the catalysts came through, government gives Intel money, Intel's chip comes out, maybe better than expected, maybe ahead of time, then, too bad I didn't buy the stock instead. I cannot stress enough, this is a trade that I definitely do not want the long-term investors to go anywhere near. It is a trade that I'm doing for the Valuation Fund show purely for entertainment because I am going to take a position on every single stock that I review. Most stocks you should not take a position on. So at least for this week, the Valuation Fund portfolio is just 50% cash and 50% invested in low-cost index funds, with the plan to invest some of the cash into this Intel bull put spread option next week. And isn't that an entertaining stance to take while also still providing some amount of education? So if you enjoy that, if you want to support the Valuation Fund show, then go ahead and become a Patreon using the link below. You'll get access to all of these spreadsheets, to my own portfolio, and you support the Valuation Fund to make these investments.